You are listening to Mining Stock Education.
When you think you've waited long enough, when you think you're buying things at the right price, you think about values they traded at, just a year ago, and you think you're getting a huge discount. If you miss the fact that there isn't any money to follow you in, then you're not going to sell it at a higher price. And the fact that this cycle in gold producers has taken 15 years from the peak of the last growth-seeking phase to the beginning of this growth-seeking phase, I think should be very instructive.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, and in today's show, you're in for a treat. We are going to have a chat with a strategic resource investor, returning guest, Dave Lotan. Dave does not do too many interviews. Dave, you're up at your beautiful summer home in Ontario. We can see the trees and the lake in the background for those of us watching on YouTube. Welcome back onto the show, and thanks for being willing to share your insights again.
Hey, Bill. Great to see you again. Thanks so much for having me on.
So you're a junior mining speculator, and you follow the cycles of junior mining stocks very closely in the commodity cycles. What insights could you share with my listeners regarding how a small cap junior mining speculator should discern where we're at in any given cycle?
I think that that when it comes to selecting investments, making sure, and I think we talked about this the last time, that the first time we ever had an interview, you said, Eric Sprott said, you have to get the cycle right. And we talked about that to some extent in a long interview that day. But I think that figuring out where you are in your own cycle involves understanding what the parallel cycles are. And so if you're investing, for instance, in natural resource stocks or mining stocks, you have to acknowledge that capital chooses between that sector and other sectors. So you probably should spend some time thinking about what's going on with profitless tech and with government bonds or crypto. And there are many other things I think that you could look at. But just generally sort of thinking about where capital is flowing to. If you don't think capital is flowing into your sector, that's probably an indication that it's a good time to invest. Doesn't mean that it's the right time. Doesn't mean you're at a bottom. But just thinking really, really hard about where the capital is flowing, and understanding that if it's flowing disproportionately, for instance, to real estate or to tech companies that are involved in social media, it probably means that the capital that's coming into your sector will only support so much volatility, so much, well, I guess in order for prices to gain, you need to have capital flowing in, not flowing out. And if capital is flowing disproportionately into other sectors, then it's probably going to put a cap on the upside in your own sector. So first, I think look at other sectors, and then I think start to look at the underlying companies in your sector. I think that if you want to focus, for instance, on gold, there's kind of a time-honored cycle there. People like Joe Mazumdar write about it all the time. You'll see gold companies seeking growth, big mergers and acquisitions like you saw in 2010. Newcrest taking over Lihir, Kinross taking over Redback, Goldcorp taking over Andean. Those were $6 to $10 billion transactions. You had a bust after that, and then you started to have the big companies selling assets to pay down debt. And then you started to have mergers and acquisitions with the big companies, which were mostly for cost savings or portfolio rationalizations. Then you had capital discipline coming into those companies in the form of dividends and stock buybacks. And finally, in the gold sector, at least, we've got a real gold price and real margins and significant cash flow. I think that Agnico cash flowed $1.3 billion in the last quarter. Kinross $650 million. These are big, big numbers, and I think should signal to investors that we're pretty close to getting back to the growth-seeking phase. And we just described that cycle in about a minute. And I would say that it took 15 years.
So patience is required. You believe in the alligator approach where you just stay on the sideline until the time is right to jump on the prey?
Yeah, I wish that were true, but I can tell you that I was nursing some pretty big losses at the end of 2015. So while I may have attempted to take the sort of Marin-Katusa alligator approach, I wouldn't say that I would have was feeling very successful about that at the end of 2015. Now, that changed very quickly, but that's often an illusion. When you think you've waited long enough, when you think you're buying things at the right price, you think about values they traded at even, just a year ago, and you think you're getting a huge discount. If you miss the fact that there isn't any money to follow you in, then you're not going to sell it at a higher price. And the fact that this cycle in gold producers has taken 15 years from the peak of the last growth-seeking phase to the beginning of this growth-seeking phase, I think should be very instructive.
I've been interviewing people since 2017, and I remember people saying back then we're in the second inning. I've been hearing people recently say we're in the third inning. So did it take from 2017 to 2025 to go one inning? Do we always, because we're so optimistic and we can see what the governments are doing with the money supply, that we just think gold's going to go up? I mean, what inning are we in here?
Well, it isn't linear. I think that these things move in big steps and they're event driven. And I guess there have been a number of events that I thought were going to kick off the next cycle in gold. I thought the most obvious moment, frankly, was when Janet Yellen went before Congress and had to answer the question, if you bailed out the depositors of Silicon Valley Bank, will you be guaranteeing the deposits of all the other regional banks? And that was a very interesting moment for gold. It reminded me of when the Prime Minister of Ireland went on television and guaranteed the liabilities of all the Irish private banks. It was not a burden that Ireland, as a country with only, I think, 5 million people could bear, and it created a whole bunch of hardship that lasted for maybe even a couple of decades. And so, having been a student of history and having seen instances like that in the past, I really did think that when Yellen went before Congress and had to answer those questions, we might be at that moment. But everything sort of went back to normal. There were a couple more banks that ended up getting taken over by JP Morgan and some of the other bigger, better capitalized banks, and things calmed down around the regional banks in the United States. And it was always going to have a long tail because they're very important suppliers of credit to small businesses in the United States. But it didn't quite do it. And now I think, given we've had a bunch of sort of false starts in the gold cycle, it would seem to me that when the U.S. embarks on sort of simultaneously home shoring all of its industries and supply chains and a trade war with the world, that we might finally better be at an event that is big enough to really kick off a long-term cycle in the gold price. And of course, we're already at $3,400. So there are smarter market participants than I who could see this coming. And often the gold price rises in anticipation of these events. But it isn't clear to me what would move us off of the current pathway. And when you're there, I think when you can't foresee the event that will knock you off that pathway, I think it indicates that you're probably still early.
So we need to pay attention to flow of funds, as you said, and we need to make sure that there's funds flowing in behind our investment in a specific junior resource stock. But you also mentioned government policy and the U.S. government policy with the trade war and some of the things the Department of Defense is doing. So how should natural resource speculators look at this, Dave? You also teach, don't you, to look at how the implications of government policy affects our speculation. How can you get ahead of the curve here?
Well, gold is the ultimate government policy trade because it does seem like, in general, nations inflate their money supply over time until they're forced to stop. That seems to have been the case throughout history, and almost every major currency has had a start and an end. I suppose some point in the distant future, there'll be an end for the US dollar as well. But that's not in our lifetime, I wouldn't say. But governments want to borrow. They don't want to tax. They want to spend. And they want to spend on large projects. And I think that in your lifetime and mine, there have always been big themes around government spending. If you go all the way back to the 1950s after World War II and the bombings at Hiroshima and Nagasaki, there was an arms race. Russia got the bomb, and all of a sudden the prevailing wisdom was that all of these countries needed as many as they could get. And the reason that mattered for junior companies is because the U.S. created a corporation called the El Dorado Corporation that guaranteed, I think, a $7 per price pound on uranium. And that was really, really important in the development of Elliott Lake, the Algoma companies, and the original Denison, Steve Roman's company. They were all able to finance these great uranium discoveries, bring them into production, and become profitable companies from penny stocks as a result of the U.S. government creating minimum purchases and a floor price on uranium. And this is, again, in the 1950s and 1960s. And so it seems to me that's really similar to what just happened with rare earths.
And antimony, right? And tungsten. We're seeing the DoD step up and fund some of these projects and make sure that projects get permits.
Yeah, well, all the war minerals for sure. I think the Department of Defense has been given a blank check to go ahead and make sure that tungsten and antimony and there's probably a whole bunch of other ones that I don't know about, or germanium, that kind of thing, are in ready supply. And of course, just because you don't see any major deposits of these things, for instance, in the United States at the moment, it's probably not so. And the penny stocks that are coming into existence because they have tungsten projects or because they have antimony projects, I'm not sure if those will work. Perpetua's Stibnite project, the gold project, lots of antimony there. I think that that's going to work. There's lots and lots of tungsten around. Fireweed has a world-class tungsten project. Agnico has a tungsten project that is world-class in Nunavut called Jennings, and Lake Searle, the mineral sands in the United States, is one of the largest tungsten reserves in the world. So you need to be careful with these things. But nonetheless, strange things happen when governments decide to go in a steady course and for the foreseeable future. And this is what happened with lithium. Lithium is entirely a product of EV mandates in the major OECD countries. So before antimony and before tungsten, lithium, I think, was the primary beneficiary amongst most minerals, I'd say, on by virtue of government policy.
Do you like when the government, as a speculator, like pushing aside your particular politics, do you like as a speculator when the government steps in, promises a floor, and begins to finance these little companies?
I don't. I'm a free market advocate, and I think that the government merely needs to regulate markets and let incentives work. I suppose when the government goes off course, and certainly we got off course on energy policy in most of the OECD countries, and this has created quite a lot of vulnerability, particularly, for instance, in Britain, where by choosing to destroy all of their coal-fired plants and to stop nuclear development, they've made themselves heavily dependent on wind, especially. And the consequence of that was that British Steel went bankrupt, I think, for a second or third time, and they just about lost their last blast furnace in Britain. They were trying, I think, as a government to give incentives for Jingyi, the Chinese company that owned it, to move to electric arc furnaces. But of course, because they had driven their electricity prices up to the highest rates in the OECD, and because electric arc furnaces run on electricity, that was never going to work. The consequences of those decisions can be many decades in the undoing, and they often require policy in the other direction to correct. And I think you're going to see that now, and there are probably lots of trading opportunities to go along with that.
Are there any specific, like, government resulted trends or flow of funds that you see that you could point us to, or your favorite, perhaps?
Well, I think that if you sort of think about the major government policy initiatives, there was the Cold War. That's what we remember in our lifetimes. And of course, that was the first great existential scare. I mean, I grew up understanding where the doomsday clock was, and that at any time you could have, somebody hit the wrong button and you'd start this mutually assured destruction process. And there were great movies about that, like War Games and Doctor Strangelove, and it sort of got into the common consciousness that we were just one bad decision away from nuclear annihilation. And eventually, I think Gorbachev and Reagan sort of undid that in what I thought was a wonderful process, and we got this peace dividend for some period of time, and it was, I guess, replaced by the climate scare, and the decision by many of these major governments to pursue net zero policies. And I think the inflation that has resulted from that and some of the issues, Spanish blackouts, etc., or the blackout in Spain, is undoing that. And certainly the Trump administration has viewed net zero with some skepticism. And what seems to be the replacement for that is now the AI arms race. And it's made quite an impression on me the way that this has been adopted on a bipartisan basis in the United States. It seems that both Democrats and Republicans are now in a rush to build data centers and in a rush to build up electricity generating capacity and electrical grids and nuclear in order to deal with the fact that it would just be unconscionable for China to get ahead of us in the AI arms race. And I think if you're a resource investor and you're a copper investor or a uranium investor, and of course there's many other metals involved in data centers and in generating electricity for data centers, that's probably something you should pay attention to.
I was just reading some of the economics of the whole AI boom, and the author was arguing that it's funded or subsidized by venture capital, that it's not self-sustaining at this point, and predicting either this bubble is going to pop or the prices are going to explode or both's going to happen. What is your take on that and how it might affect us as commodity speculators?
Well, there was quite a lot of venture capital that went into solar and wind, and not just into solar and wind, but into lobbying for government policies that would tilt the playing field in favor of solar and wind. And if we're to look at that and the amount of government money that went into that as a result of the venture capital money that seeded it and lobbied for it, I would say this cycle would probably last longer. I'm not exactly certain. I mean, eventually, as you got solar and wind onto grids and you got these problems with intermittency and the promise of endless cheap power failed to materialize and inflation materialized instead, it was likely going to bring about a reduction in the rapid nature of adoption, and that would start a cascading process which would begin to work against that. I don't see where that moment is in the future for AI. And given that it took the world a long, long time to hold all of the promises around renewables to account, I can't see that moment on the horizon now, not from here. And maybe it's right around the corner. I don't know. I'm not perhaps qualified to know.
Are you using AI in your own due diligence in your personal investments within the resource sector, or does most of your ideas come through a relationship? Or once it comes through a relationship, do you use AI to further vet it?
I don't.
You're old school.
Well, most of my resource investing is instructed by travel, relationships, boots on the ground kind of stuff, and I think maybe the market will one day do away with old speculators like me. But at the moment, I need to see the goods.
So then, this is something I've been thinking through, Dave. What you just described, like that's a qualitative approach, right? Where you are the agent. It's not an AI agent analyzing things. You are the agent, and you're analyzing quality and probability of a success. Would AI ever be able to actually look at it from a quantify the qualitative aspects of speculating in these little companies that we speculate in?
Good question.
Okay, well, it's something I'm thinking about. You don't have to answer. It's what is the best utilization of this technology, and how do you maintain an edge for people that have been in this sector, if your edge has been the relationships, if your edge has been you as the agent being able to see opportunities, spot opportunities, pick up on bottoms, know what value is, know what a pump is, all those things are inherent. It's built into your psyche now to where you can see it.
Sure.
How would you train AI in that?
So there's a lot of things that you have to measure in this business. Valuation would be one obvious one. And when it comes to determining where you are in the flow of funds, there's a fair amount of work that goes into that. But once you've done the baseline work, it becomes very easy to detect when money is leaving and when money is coming in. If you understand the population of investors in this space and who they are, and for instance, when the first Rubicon failed, and it vaporized a whole bunch of money for the Canada pension plan, it seemed fairly obvious to me that CPP would probably get out of at least gold investing. And so when it came to understanding, what the total amount of dollars available for investing in resource stocks was, you looked at that big pool of capital and you said, well, let's say 10% of CPP's money or 5% was available for investing in natural resources. Well, let's just wipe that off the map right now. That's gone. And that makes the whole process seem simple, but in reality, you spent a lot of time building up your cohort, putting together data sets to understand how much money was there. And then what you really care about is big new entrants and big new exits. And so I think AI could play a role in building the data sets you need to measure the various measurable components of this. But when it comes to understanding what success looks like in this business, a lot of data disappears. So if you try to get, for instance, a stock chart on Virginia Gold, one of the great prospect generators of all time, Andre Gaumond, and the story of Eleanor, and all of the 75 joint ventures that he did before that, and Coulon Massif, which is in some other company right now, it's really hard to find. There was so little ever written about it. If you weren't there and you didn't see it happen, it's not part of your historical experience, and it doesn't inform the way you think about investing. So I like to think that one edge you can have in this business is experience, and another edge you can have in this business related to that is memory. And Luke and I talk about this all the time because Luke does fantastic data analysis and visualization. And
Luke Tenhave from
exactly.
Discovery.com for those that don't know.
One of my great, partners in this business, intellectually anyways. We don't do anything commercially together, but Luke is just somebody that I like to talk to every day if possible. And but we've talked a lot about how one goes back and looks at how other successful stories have unfolded or great failures or frauds have unfolded. And it isn't quite as easy to get the data because, of course, these companies exist for a while and then they don't exist anymore. They get rolled back or restructured. So memory, and therefore experience, because you can't remember anything if you don't have experience, I think is really an important edge in this business. And maybe AI will blow that to smithereens. For now, I prefer to think of it as an edge, and an edge I might have.
All right, so let's apply your analytics to a couple recent M&A that we've seen. Minera Alamos acquired a producing gold mine, Calibre's old Pan mine in Nevada. It's a smaller mine. What do you think's going on here? Do you like it?
Yeah, I remember when Pan came public in Midway, and of course it went bankrupt. And I'm not sure if Waterton had it for a while, and whether or not Frank Giustra and his gang bought it off of them and then put it into Fiore Gold. And then, of course, Fiore was taken over by Caliber. It's an old asset. It's not a big asset. And I guess the theory or the business strategy there is, well, let's look at what happened to Heliostar when they bought a couple of these old assets from the corpus of Argonaut and also Integra, which bought Florida Canyon, I think, also from Argonaut, as the company was being broken up and sold off for parts. And the stub cash flows, the cigar butt cash flows from those tired old assets have been pretty good for both Integra and for Heliostar, and have been enough to help those companies raise capital at better prices and to potentially move their businesses forward without having to go to capital markets again. And I hope that's true. I really like George Salamis a lot, and I thought that George and Jason Kosak, who I guess collaborated on that decision, did something which turned out to be fairly smart there. Smart in that they, took a risk and got lucky on the gold price. Same with Charles Funk at Heliostar. So now what the market does is when they see when it sees something work, or what market participants do when they see something work, is they make more. And Minera Alamos is the echo of Heliostar and the echo of Integra. And the question is, are the assets better or worse? And will the strategy still work? Are we early in that strategy? And I just say, hard to determine, but the fact that Darren Hall bought those assets at one point in time suggests that those assets had technical merit. Darren's a venerated operator in this business. And it's very understandable that now being inside of Equinox, those assets are no longer of interest. So there seems to be a good reason to sell them, which doesn't relate to quality. And there seems to be a good reason to buy them, which relates to the positive experience of Heliostar and Integra. And the two lead orders in that big $100 million financing, I know quite well, and they are very, very sharp investors. They got a better price than legacy shareholders, I guess, is the complaint that everyone is making. But I think those orders together were $37 million, and there were a bunch of other big checks there. So it seems to me that at least at the price it's being paid by the incoming guys, there are smart guys who think this is going to be a success. And if we're early in the cycle, I think that that's probably true. I'm not an investor. I like everybody involved, I guess, but it's not the kind of play that I typically get involved with.
What do you think about the Torex and the PRYM deal?
Right. So that's a really interesting one. And of course, it relates to what we just said, because of course, the asset in PRYM Mining was sold to PRYM Mining by Minera Alamos, the Los Reyes project. And I think they bought that from Andy Bowering, bought that from Doug in 2019 for a total of about, I'm going to say, sub $10 million in compensation. There was a stock component at 30 cents a share and some cash payments, and the assumption of cash payments owed to Vista Gold for those assets. So they were in Minera Alamos, and they have now recently just traded for $450 million, I think, in the sale to Torex. And so that's just an interesting side note, since we just spent time talking about the Minera Alamos story. And I'd just say that I guess it's a bit unfortunate for them that they sold that asset in order to move forward on the things that they were working on, if it's true that this value was available, and probably not to them because it's in cartel country, and the people who've moved that project forward needed to raise their own capital, and they attracted Pierre Lassonde and his constellation of investors, and of course, that in and of itself can really push up the value of a company. But Torex has now validated that value by buying it, and I think that that's fascinating. They're smart people. Their assets, I thought, were undervalued. And I think if cartels and violence in Mexico are part of the problem in that story, I don't think they're going to get away from that with this purchase. So I just think that it's really the magic of Pierre. He's, one of the best investors and one of the best sellers in this business. And maybe there's something in that. Maybe there's something to take from that.
Pan American Silver acquiring Mag Silver. Yeah,
I never thought those guys would sell. That's incredible. They had a pretty good gig there. with Fresnillo operating the mine and pushing things forward. And so I salute them. I think that was a great thing for MAG to do, to combine with a bigger, more diversified entity, and to give themselves, therefore, the power to be on an even financial footing with Fresnillo, who at some point I'm sure could have put them at a financial disadvantage in that joint venture. So I think that's a great buy by Pan American, great silver beta, great silver alpha, I suppose. And I think give George and the guys at MAG a lot of credit for being willing to give up those paychecks and do the right thing.
Equinox and Calibre. Now, I heard from a lot of Calibre shareholders that were not thrilled with this transaction. What is your analysis?
I always thought that Marathon was going to be a difficult asset. There's a lot of water there, and it's a multi-pit scenario. And I've always thought that when it comes to open pit mining, one should think about whether you're buying a multi-pit scenario or a single pit. And I guess the great disappointment for Newfound Gold is when they finally published their resource. I think there's 31 pits there. And that isn't an easy thing to do. I won't get into the complications involved in that. That's a whole show. And you've got lots of technical guys who do your shows who I think could do a better job of that. But it's something one should think about when one is buying a development play. How many pits? So I just think that was a really ambitious use of great cash flow to Nicaragua by Calibre. I'm not sure why they were so desperate to get it in Nicaragua, because I think it's a fantastic place to operate. Doesn't mean it's the best country in the world. And for people who have ethical objections to the way it's governed, I completely understand that. And I didn't think that Calibre had enough capital to handle Marathon, but they did an amazing job of getting the equity price up and an amazing job of raising follow-on capital. But it does seem like it wasn't quite enough. And probably that was going to become apparent and made it a good outcome to team up with Ross and get scale. And I don't think that can be underestimated in this business. Hard Rock in Ontario, or Greenstone, whatever they call it now, and Valentine out in Newfoundland are they're far apart geographically, but they're both Canadian opportunities, and they're similar opportunities. And the narrative behind that is that Darren is a fantastic operator, and he'll turn both of those mines into world-class operations. And I think that's possibly true.
What about Sandstorm being bought by Royal Gold?
Yeah. What about Horizon Copper being bought alongside of it? Yeah, I thought that was quite interesting. I think it's fantastic that Sandstorm opted in favor of its shareholders to go for scale in the business. I wasn't sure about the inclusion of Horizon there, but I guess I don't know the situation all that well. But nobody wants to give up their paycheck in this business. And if Nolan Watson and some of the very good and smart people at Sandstorm, Dave Oram, good friend of mine, great guy, thought that it was the right thing to do to pass the keys over and go for scale, I think that maybe foreshadowed some of these big transactions that you're seeing now. So I can't remember if Franco-Nevada had already bought the Treelon royalty at Cote Lake for $1 billion, this 7.5% gross profits royalty, or whatever it is. It's confusing structure. The Silicon transactions hadn't happened yet, and Tether had maybe just gone into Elemental Altus. And given the magnitude of the transactions, the values that are being paid for them, I think that now the royalty game is moving towards scale, especially the gold royalty game. I shouldn't throw all royalties into the same category.
So there's not going to be mid-tier royalty companies? They're all going to get eaten up?
Well, Metalla, I think, will go at some point. I don't know when. I think the revaluation of their Cote Lake royalty by virtue of this Treelon purchase on the Cote Lake royalty or on the Cote Lake mine, I think is the beginning of that company getting a better valuation. Of course, they paid down all the expensive debt they had with Ryan Beatty, and it's become a bit more of a grown-up company now. There's not much else there now. I think Groy, Gold Royalty, Dave Garofalo's company, is still out there, but the Mavericks, the Nomads are gone. So the mid-tier royalty companies are fewer now than they were. And there are a bunch of startups out there, Empress, and I guess Ecor is still technically a mid-tier. Maybe they'll go at some point as well. Tether's arrival in the gold royalty business is maybe the beginning of some really, really crazy pricing there, but we'll see.
Where the Bitcoin bros become gold bugs?
Well, it's the same philosophy. The BitGold guys, Roy Sebag and Josh Crum, went around to all these American universities talking about gold and what happened in 1971. The beginning of the devaluation of the U.S. dollar. Taking the U.S. dollar off the gold standard by Nixon and Connolly. And I remember hearing back from that sort of campaign that what they'd done is gotten all these university kids crazy about Bitcoin and not about gold. And people don't remember the BitGold promotion. I think that company renamed itself Gold Money after they bought James Turk's business. But it is the same philosophy, and it seemed to me that at some point the Bitcoin crowd would start to move in reverse, and probably FTX and the FTX scandal was the beginning of that.
Dave, when you're doing your qualitative analysis of the people behind the investments that we speculate in, and you're told something about somebody from somebody else. So, for example, I've been told like so-and-so is addicted to drugs or so-and-so engaged in this type of immoral activity. And I personally don't have any way to vet that information other than analyze it through the lens of my perception of the integrity of the person telling this to me. How do you deal with information like that when you receive it about somebody?
With a high degree of skepticism. This business is all about competing for capital. And capital the other guy gets is capital that you may not get. And these are narrative businesses, and they require storytellers and good storytellers and storytellers that create sort of a magnetic attraction. And I guess if you're not telling your story as well as you should and attracting capital, one way you can make your story relatively more attractive is by attacking the next guy's story. So I guess it would be natural that this business would be full of jealousy and I suppose some negative activity around ad hominem attacks and maybe attacks on the reputations of others. It's, I'm sure, true from time to time. We're all human and everyone has their flaws. But I think one should be careful about rumors and gossip in this business.
So when do you go public when you think somebody's a scumbag? Do you ever go public, or do you just share those things, person to person in private setting? And what is the accountability structure, if any, for junior mining executives that are not good characters? Because this is a concern from retail that's even been expressed to me. Is there a purifying mechanism within the junior resource sector?
Sadly not. Eventually, when investors have been rewarded with negative returns and broken promises and humiliation for having been so gullible, I suppose they move on. But there are lots of characters in this business who succeed once or twice and then I suppose don't serially. And often, I guess, are full of promises and exaggerations, and I guess maybe dishonesty, although one can always mask that as optimism. But that's true, I suppose, at the highest levels. I mean, one of the biggest scandals of the last few years was FTX, and some of the sharpest investors in supposedly in the United States, Sequoia and all of these big venture capital firms were just fighting each other to get money into Sam Bankman-Fried's enterprise, and of course Elizabeth Holmes at Theranos. So the junior markets, I suppose, maybe it's tawdrier, and because it's more of a flea market than it is a stock market, it just looks worse. And when you figure out that you've been victim to it, it's a little more humiliating because, of course, in retrospect, it all looks so transparent. But I'm not sure who believed you could take a tiny, tiny little drop of blood and subject it to all of this analysis and get the same kind of information you would get from that from taking a liter of blood or some whatever the typical specimen is required to test for all these diseases. And yet some of the most sophisticated investors in Silicon Valley and politicians were involved on the board of Theranos, and so it's not, in my opinion anyways, any worse in junior markets than it is in the major markets. But of course, because we all get to know these CEOs, they stand at booths, they talk to us, they lie to us. Sometimes they don't. It just has a more personal feel to it.
The junior mining market's more like a flea market than a stock market. I haven't heard that one, so that's I'll add that to my repertoire of quotes. Last question, and if you don't want to comment,
it can be more like a flea market than a stock
market. Okay, it can be.
And I love these markets, and I find them very useful. I don't think that mankind lives off of stuff, and people constantly need to be looking for more of that stuff so that it can be developed and can help serve society's needs. So I respect this market. I just understand that it's high risk and that one needs to come to it with a high degree of skepticism and due diligence.
Okay, last question. And if you don't want to comment, just say no comment. Hydrograph. This has been one of the most effective social media promotions that I've maybe ever seen. In the last 60 days, it's gone from like 16 cents, I think US, to, I don't know, $2 and something. I don't even know what it's at the time of this discussion, but it was at least a 15x at one point when I looked at it a couple of days ago. Any thoughts, Dave, on this? Whether comments on the promotion or the legitimacy of what they're laying out there?
Yeah, I don't know anything about the company, and I guess I have seen a lot of comments on it on social media. I don't even know, has it had a big return?
I think it was 16 cents in July. Like if I can pull it up as we're chat, but it was like a 15x.
Right.
Is within 60 days, which on massive volume, which that's somebody's going to be really right or somebody's going to be really wrong.
I've never seen the stock chart, and I haven't looked at the stock, and I do understand that there's at least one sort of prominent social media personality who's been an advocate for it, and I don't know that person other than by reputation, and I understand what that person's history is in capital markets, and that's a very legitimate resource investor, in my opinion, having seen some of the operations that they were involved with in the past. And that's really all I know about the story. We're all, as resource investors, when we own a stock, quite pleased when whoever is running it or the investors in it attract attention. Maybe they go on BNN. I mean, Paul Van Eden was so famous in the early 2000s. He'd go on BNN, he'd talk about penny stocks, and those things would double or triple the next day. And then Brent Cook, had that sort of aura as well. And I think, what makes stocks go up is advertising. And if you're involved in running a junior company, it really is your responsibility to fight to get the attention of investors. Not to stab the other guy in the back or start rumors about them, but to make sure that investors are aware of your company as an opportunity and what makes it special. So I am personally not against advocacy campaigns, although some people would call them pump and dumps. I don't personally get involved in them. And of course, the companies that I sit on the board of and own large percentages of don't, for instance, purchase those kinds of services. But in this case, it seems to me not to be cut and dried. And I don't think anyone should be comfortable calling that particular stock or the advocacy that's going on for it a pump and dump. And that's just an opinion. I don't know the story all that well, but I think that would be all I'd be comfortable saying about that.
But if I know you, you'd be cautious buying too after a 15x move within 60 days.
Well, I don't buy anything that I haven't done a lot of work on. And I mean, in tech investing, when things go up 15 times, the chances that they're going to double and triple again are actually quite high. And in natural,
that's counterintuitive.
And in yeah. I mean, well, that's the way the passive investing works. When you get a bigger market cap and you become more liquid, more and more, you get more index inclusion. You get included in more of these passive financial products. And so, I mean, Cathie Wood, when she was at her peak during COVID, had to publish her holdings on a daily basis in the ARK fund, and I think that those companies benefited tremendously from inclusion. And of course, she went on CNBC a lot, and she said things which I suppose in retrospect seem fantastical, but which she believes to be true. And I think one needs to be careful and separate, that genuine sort of analysis and belief, whether you think it's flawed or not, from people who are using these sorts of campaigns where you hire 10 or 20 different influencers and you divide money between them all and you have them go out on a single day or in a single week and talk up a stock and then create price momentum that's unexplained in the market, and maybe there's some compounding on that. That's a very different process, and I'd say in some cases potentially morally bankrupt. But when someone really believes in something and they use their media platform to promote it, and it's clear that they can't sell it without people knowing about it, I would say, probably just because it looks like one of these old time-honored direct mail campaigns doesn't mean that it is. And let's see, maybe we're going to get into a resource market where when stocks go up, they go up more. And wouldn't that be great?
That's what we're in it for. It's a lot of risk, a lot of opportunity costs we give up in order to make those gains.
Yeah, good.
Dave, always great chatting with you. Any final thoughts you'd like to leave us with?
Great to talk to you again, Bill. Sorry it's been so long.
Okay. Thank you for coming on the show today, Dave.
Okay. Cheers.